Welcome to Eye on the Money, the television show that gives you insights into how to improve your financial well-being as well as how to make your money work for you. I'm your host, Ingrid Nantege. Now in today's episode, we'll take a keen look at the savings culture in Kenya. According to data from the World Bank, Kenya's level of savings as measured using the savings to GDP ratio has over the last 4 decades declined from a high of 27% in 1977 to slightly below 5% by 2017. This has been a source of worry to economic policymakers, considering that savings are what drive investment and economic growth. Kenya compares quite poorly with countries such as Singapore, Suriname, and China that have managed to mobilize savings levels equivalent to nearly half of their gross domestic product. Interestingly though, at least a quarter of all loans extended by commercial banks go towards personal and household credit, going by statistics by the Central Bank of Kenya as at June 2018. So why the mismatch? To delve deeper into Kenya's saving culture and what can be done to raise the level of saving in Kenya's economy, I'm joined by Reginald Kadzutu, Chief Investment Officer, at Amana Capital. I invite you to be part of the conversation by sending your comments and feedback to our social media handles at Metropol TV KE on Facebook, Instagram, and Twitter. You're welcome, Reginald.
Thank you, Ingrid.
Thank you very much for joining us in studio.
Thank you.
You heard the figures.
Yes, and figures don't lie.
Figures don't lie.
They're actually true. I think the statistics that are coming out are figures that, unfortunately, the policymakers do actually know. The general populace might not know, but there are figures that point to not so rosy a future if we don't start changing the direction of those statistics. You'll find when you start having a saving to GDP ratio which falls below 10%, but you have a debt to GDP ratio of close to 60%, then you start wondering, where are we going to get the money to pay the debt from if we are not saving anything to actually pay that debt? So it is falling or going towards a boiling point. Might not be now, might not be in the next 2 years, but if it's not turned around, it will actually be a crisis.
Just to interject there, you used a very strong term, boiling point. What are the repercussions? What does this mean if, like you said, we don't get on top of this?
If you don't get on top of getting into a culture of saving, or the country getting into a culture of saving, living within their means and actually save, is taxation. There's a saying that says taxation takes away consumption today. Debt takes away consumption in the future. And if there's no saving in between, you'll actually have no future, because debt has taken away that future. It's a boiling point because everything around us seems to be pointing towards people getting more debt than trying to encourage people to actually save for a financially stable future. You have mobile loan applications coming on board. It's actually easier to get a loan than to save. Yeah, and that's what I'm saying. It's getting to a boiling point where debt becomes the answer to any financial problem that you have. I will borrow my way out. Yeah.
I like how you mentioned it's easier to get a loan than it is to save. Because again, from our figures, from our graphs, we can see that a lot of loans that are taken out by the people in Kenya, they don't even go towards development. They don't even go towards personal development. They go towards things like household items. They go towards expenditure again. What does this mean? What's your comment on this?
It's the typical definition of a debt trap, where you have to start borrowing to fund all your expenditure. And borrowing in itself is not bad, depending on what you use the borrowing for. And borrowing or using debt came from the element of you're trying to leverage. You're trying to extend your capital to generate more revenues and be able to pay for it. But the problem that we have is that we have people leveraging on no capital, from the individuals all the way to the national government. So when you leverage and you are leveraging into a venture which is not generating enough cash flow, inflow streams to pay for the debt, that means either you'll have to eat into your current cash flow inflow streams to pay for the debt, or you have to borrow more to pay for the debt. So you end up in a vicious cycle of, I have this loan, it's coming due, I have to borrow more to pay more. Just like the Eurobond. Government is about to produce the prospectus of the next Eurobond. And trust me, not a single cent of that $2 billion they want to borrow is going to go into any development whatsoever. It's going to pay the retiring of the Eurobond that is due this year, which now becomes a sad state. So we now have a debt which is not actually going to go into any development. The first Eurobond, we're still trying to account for it. No one could put a finger where the money actually went. This one, we know where it will go. It will pay debt. So we are going to be servicing a debt that paid debt. So it's not going to generate any income for the economy. And trust me, by the time that debt is coming due, if serious and hard policy decisions are not made, we'll be borrowing again to pay for that debt. So you're killing a generation every decade a bit. Every 10 years you steal another 20 years. Every 10 years you steal another 20 years. So we enter into a vicious cycle of poverty that we can't come out of.
Reginald, let's talk about the real issue at hand. Why does the saving culture in the country remain so poor?
Interesting. I'll give you 4 points to answer that. And the first one, or the first 2, 3 might seem a bit far-fetched. But I think it's a problem that we actually need to go down and actually realize it's the root of the problem. Number one is the general African culture, where we came as Africans, especially the hunting, gathering, you kill and you eat, no refrigerators, no technology for storage. So we grew up in an environment where you eat it now before it gets rotten.
That's true.
And unfortunately, we have carried over that same tendency even to our finances. We don't think of tomorrow. Tomorrow, I'll go deal with tomorrow. I'll go look for another deer or buffalo to kill tomorrow. You can store grain up to a certain level. So there was always a consumption-driven culture traditionally, especially when you go to the rural areas. And it now is infiltrated even into our finances, where we don't think past the next 2-3 months or even the day that you're living in. So that's number one, why we have a low saving culture. Two, particularly now to Kenya, the Harambee culture, where a child is born and at 18 they have to go to university. So the God has given you 18 years to plan.
You know it.
Yeah, but people will wait for the 18th year and think, this kid has to go to university. Call all the neighbors, do a Harambee, call a politician, have a basket, people put money. So people don't know that I'll just go to the community, do a Harambee. That's another thing that actually affects saving. The third is what our parents would say, that I invested in my children. So I expect when these children do well, they will take care of me. Right. So that's why people like a girl child because there's dowry, they like a guy because at least to be able to take care of you when you're old. So that's why you find most people don't have retirement plans, they don't have pensions, because I think my kids will take care of me, which is a wrong culture, especially in this day and age and with kids like you and me. We take care of yourself, or we'll send you to an old people's home at the end of the day. Right. So that's the third one. And the fourth one is fiscal and monetary policy that has just not made it conducive for or incentivized people to save. So I think those are the basic 4 reasons why we have a very poor saving culture in the country.
My next question will kind of tie into your 4th point. And I'll ask, because I read somewhere, that especially in Kenya, the reason why the saving culture remains really low is the economic environment may not also be too favorable. High inflation, and all those other things that come with the package. So what role does a stable economic situation, what role does a country's economic situation have to play in actually also having a good saving culture? I'll
give you an example of Japan. Japan's saving, general popular saving, was below 10% in the 1960s and the 1970s. And it grew in leaps and bounds until it peaked at around 38%. The savings culture actually grew during a time when the economy was in shambles. So it is not really the state of the economy, it's actually the impetus of the government and the authorities that be in that. Do they actually want to push a savings culture? Do they actually want to help or create an environment for people to save? So if you look at the Japan example, one, they did not try to create state welfare. give spendits to old people, or follow the US model of unemployment benefits. They encourage people to save. They did not try to tax away the incentives to save. So you'll find they'll give tax-free employment saving plans. So if you save through an employment saving plan, it will be tax-free. Their postal service, which will be equivalent to our posta, those savings accounts were totally tax-free. So it encouraged people to save. Here in Kenya, try to put a fixed deposit. The KRA is waiting there with 10%, 15% withholding tax. So you find that there are so many taxes that try and eat into whatever you're trying to do as saving. So it reduces or removes the incentive for the normal person to save. Kenya is one of the highest tax to GDP ratios in terms of percentage, where you find Japan reached a low of close to 14-15% tax to GDP ratio, meaning that they did not tax their populace so much. They allow the populace to actually save, encourage them to save. And Japan came out of a serious recession after World War II, generally because they got money from savings. People saved in commercial banks, people saved in postal services savings account, and that money was what the government now used to fund organizations, fund companies, your Toyotas, your Sonys, your Hondas, your Mazdas, and all those guys, your Mitsubishis and your Toshibas, were all funded from the saving of the general populace as people saved. So we have that problem where there is no incentive to save, and where there is an incentive to save, we have rogue personalities that come. Now you had the SACCO stories, you have the pyramid schemes, you have bank executives stealing money, banks collapsing. It all comes to dent the incentive to try and get anyone to actually save. So I think the government has a role to play. The fiscus and the monetary policy side have a role to play. Like right now, the monetary policy stance is trying to keep interest rates low. They're trying to cap interest rates because everything seems to be more debt driven. We want the banks to lend out more. Why not take a different stance and say we want people to save more? So let's increase interest rates to this level. We encourage people to put their money in savings accounts. So for example, the highest saving to GDP ratio Kenya had was around 93, 94, where it was around 43%.
Yes.
And interest rates at that time were at 80%. So automatically people saw 80% interest rate, let me put my money on a fixed deposit. But right now, put your money in a fixed deposit in a bank, you get 4%, 5%. No incentive to save. So there's a lot of incentivizing that the government actually needs to do from the fiscal side in terms of taxation to encourage people to actually save. Make it conducive. Right now, the environment is not conducive for people to save. When they come to people like us, like Amana, we now have to try and pull the funds, try to use the muscle of pulling to try and get them a higher rate than their 4%, maybe push it about 9-10%. But it should not be like that. It should be an open playing field where someone decides, I need to save. I can save through all these other vehicles, and regulation is there to protect their savings.
So Reginald, what you're saying is, currently with the situation, the saving culture as it is in the country, you called it yourself, we're at a boiling point. Interventions are needed right away if a difference is to be made. And what Kenya needs to do is just pick a leaf from other economies, from other countries that have managed to make it work. So we're going to take a quick break, but we're going to carry on with this discussion. So I invite you once again to be part of the conversation by sending your comments and feedback to our social media handles at Metropol TV KE on Facebook, Instagram, and Twitter. We'll now take a quick break, but do not go anywhere.